Without a good credit score, you can't get a home loan, car loan, or any personal loan. Certainly, you will be paying higher interest amount in your loan repayment, or you might not get a federal job. So, you must learn to boost your credit score. In this video, you will learn about what is credit score, how credit score is determined, and how to increase the credit score. After watching this video, you will know how to increase credit score without spending a dime. At the end of the video, based on my banking experiences, I will share a surprising bonus fact. Before we get lost in the content, why don't boop that like button and subscribe to the channel? You will get more value videos that will help you achieve financial freedom faster. While I worked at a bank, I approved one's personal loan with 22% interest rate and others with 9%. Why is that? It's due to credit score. So what is credit score? You can say that it's a trust score. Bank use a number that basically tells you how trustworthy you are in the eyes of bank. A credit score is based on the history of credit, like the number of open accounts, overall debt amounts, repayment history, and other variables. To determine the loan repayment ability of a person in a timely manner, lenders tend to use credit scores. Credit score is the number between 300 to 850 which depicts the creditworthiness of a customer. The higher the score, the better face value the borrower can create in front of the potential lenders. The Fair Isaac Corporation, FICO, created the credit score model, which is used by financial institutions to determine credit scores. Among other credit scoring systems, the FICO score is by far the most commonly used one. This score is used by the majority of the banks and other lenders. The scores rely on consumer credit data taken from the three national credit bureaus, Experian, Equifax, and TransUnion. If you maintain an excellent credit score of 800 and above, you will always save money in the interest payment. In the long run, you would potentially save tens of thousands of dollars. What credit score is good? Put another way, a credit score of 700 or above is usually considered good and can result in a lower interest rate for a borrower. So, the borrower will have to pay less interest payments over the life of the loan. Scores higher than 800 are regarded as outstanding. According to Shift, 21.8% Americans have a credit score higher than 800. Although each lender determines its own credit scoring ranges, the average FICO score range is also used. How credit score is determined? As per the news published in CNBC, 4 out of 10 Americans have no idea how to calculate their credit score. If you understand this, you can increase your score in no time. Though most of the agencies keep their exact formula secret, you can at least know the weight of each category in FICO score. Here are the precise details of 5 categories. 1. Payment history. 35% of your score is compensated through your payment history. This illustrates if you make timely payments, how much you skip payments, how many days after your due date do you pay your bills, and how recent payments have been skipped. The greater your percentage of on-time payments, the greater your ranking would be. You negatively affect your score any time you miss a payment. 2. Amounts owed or credit utilization. How much you owe makes up 30% of your score on credit cards and loans. Comparing to how much credit you have available. This is dependent on the overall amount you owe, how many and what type of accounts you have, and the amount of money owed. For example, if you have a $10,000 credit card and maxed out, your credit score will be low. Once you start paying off, your score will increase. Length of credit score history. The length of your credit history accounts for 15% of your score. When your history of making on-time payments gets longer, the higher your score becomes. It might seem prudent to avoid applying for credit and carrying debt, but if creditors have no credit background to check, this may also negatively affect your score. Types of account you have. 10% of the ranking is made up of the types of accounts you have. Your score can be strengthened by providing a mix of accounts, including installment loans, home loans, and retail and credit cards. Recent credit activity. The final 10% is made up of recent credit operations. If you have recently opened a lot of accounts or applied to open new accounts, it might indicate possible financial trouble and may reduce your score. However, the score will go up over time if you have had the same loans or credit cards for a long time and paid them promptly, even after payment issues. Now you know what makes your credit score. Let's learn some strategies to increase your credit score. 1. Treat your bills seriously. When lenders evaluate your credit report and submit a credit score for you, they are quite interested in how consistently you pay your bills. This is because the past payment performance is usually considered as a good forecaster of future performance. You might want to pay all bills on time, not only credit card bills or any kinds of loans you might have. It is also a smart option to use the services and tools available to you, such as automated payments or calendar reminders, to help ensuring that you pay on time every month. When you're behind any payments, get them up to date as soon as possible. Because late or missing payments seems to be a negative information on your credit report. You might have a positive impact on your credit score by paying all your bills on time as consented each month. Remember, both paying ahead of schedule or paying less than you originally promised to pay can negatively impact credit scores. 2. Get credit for making payments, utility and cell phone. If you've made your utility cell phone bill payments on schedule, it's an opportunity for you to raise your credit score using these payments. The people who don't have much of a credit history might have a history of paying their rent on time. But that information isn't showed up on their credit reports, and it isn't possible for you to report rent payments by yourself. Rent reporting services are the ones who can get your credit reports to reflect your rent payments. For this, your landlord has to bear a yearly cost of $100. Rental Karma and Level Credit are such rent reporting services that take a bill you are already paying and put it on your credit report. This data helps in building a positive history of on-time payments. Not every credit score takes these payments into account, but some do. And that might be enough for you to get a loan or credit card. 3. Be cautious to new credit accounts opening. Do not open several accounts just to have a better credit mix. By opening multiple credit accounts, your credit score won't be improved. Because multiple application from an individual for card in a short period of time might make you look like a riskier borrower. Applications can affect your score in a different way. The points lost due to credit applications are likely to return within almost 6 months. So, if you are planning to apply for a loan within a short time, before getting the loan's final approval, it's better not to apply for any other credit for at least 6 months. 4. Pay off debt and keep balances low. In calculating credit score, the credit utilization ratio is necessary. This ratio is determined at any given time by adding all your credit card balances and dividing the number by your total credit cap. For instance, if you normally charge around $2,000 per month and your total credit limit is $10,000 for all your cards, your utilization ratio is 20%. Look at all your credit card receipts over the last 12 months to find out the total credit utilization ratio. Attach the statement balances from all your cards for each month and divide them by 12. That's how much credit, on average, you use every month. Mostly, lenders prefer the utilization ratio of 30% or less than that. A low credit utilization ratio informs lenders that your credit cards have not been maximized and that you probably know how to handle credit well. You can affect your credit utilization ratio positively by paying off debt and keeping credit cards balances low, becoming an authorized consumer on an account of another person, as long as they use credit responsibly. 5. Lock up your unused credit cards. Closing an account might improve your credit utilization ratio, but keeping the cards open has its benefits too. In case you're not struggling with your credit card debt, don't just close those. Instead, you can put them in a secure drawer. It is a good strategy as long as they don't cost you money in annual fees. Closing your credit account causes that account from aging, which affects your average account age. Your credit scores can be lower if you owe the same amount but have lesser open accounts. 6. Consider increasing your credit limit. The decrease in your credit ratio helps increase your credit score. When you have a credit of $500 and your credit limit is $550, your utilization ratio is 91%. On the other hand, When you have a credit limit of $800 but have the same amount of debt, your ration becomes 62.5%. And the lower the ratio is, the higher your credit score goes. A higher credit limit also leaves the door open for making larger purchases. It can be your friend in need in times of emergency situations. 7. Dispute inaccuracies on your credit reports. Incorrect information could drag down your scores on your credit reports. Make sure that the accounts shown in your reports are accurate. You can get a copy of your credit report every year from the 3 credit bureaus by visiting www.annualcreditreport.com. These credit bureaus are legally obligated to investigate if you dispute any accuracy on your credit report. If you see mistakes, challenge the data and instantly get it corrected before the inaccuracies can do harm. Checking your credit on a regular basis can help you spot them easily. 8. Become an authorized user. Adding someone else on your credit card as an authorized user helps increase their credit score. An authorized user gets to use credit but cannot be held legally responsible for paying debt. Becoming an approved consumer on the credit card account of someone else is a technique for rapidly enhancing credit. It works better if there is a long record of on-time payments on the primary user's card and the registered user does not have recent blemishes on their credit history. 9. Improve your credit mix. A robust credit mix can surely boost your credit score a little. Opening a credit card is a convenient way to use revolving credit to pay your bill every month on time. For your credit mix, make a list of credit accounts you have, and which loans might be necessary for you at this time. Consider opening a personal loan or other forms of secured loan if you don't have an installment loan and only have credit cards. But keep in mind that opening too many credit accounts just to get a better credit mix isn't a wise thing to do. Now, it's the time for bonus suggestion. If you don't want to get a credit card or personal loan to increase your credit score, but you need a good score to get a home loan. So, what to do? The answer is to save 10% of your income every month and show to the bank manager that you can manage your money wisely. If someone can show consistent money-saving behavior, that means that person can repay the loan on time. This will give enough confidence to the bank manager. So that's all. If you find any value out of this video, give it a like, and share the info among others, so that they can get benefit too. We'll see you in next video with more interesting facts. Peace out.